Stock Market Analysis Part 2. Yield Curve Inversion Current State. An inverted yield curve is basically when the yield on a 2-year US government bond exceeds the 10-year US bond yield, as worried investors opt to disinvest from risky assets in favour of safer long-term government bonds, thus driving down long bond yields below that of near-term bonds. And the closer the yield curve gets towards an inversion, the greater the likelihood for a future recession. So far, the yield curve inversion has successfully forecast the last 3 economic downturns in the United States, though the yield curve inversion has proved less reliable elsewhere, especially for Australia. The Fed put up a valiant effort to prevent a yield curve inversion, i.e. recession indicator, all year, finally failing during late August, which triggered a barrage of action to immediately reverse the inversion, most notable of which was September's rate cut. Does anyone recall the Fed's rate hike mantra of less than a year ago? Which illustrates watch what they do rather than what they say. So US long bond yields have risen. Though at 0.06, the Fed clearly sees much more work to be done, which means to expect US long bonds to fall in price as the Fed attempts to bring the yield curve spread back into the year's range of 0.1 to 0.3 by the Fed engineering lower short-term rates and higher long-term rates, which should be a net positive for stocks, i.e. favouring risky assets. And not to forget that even if the yield curve inversion does herald a recession, historically it can take 10 to 20 months from inversion for the recession to materialize. And do subscribe to this YouTube channel for the next video in this extensive series of analysis. However, the whole of this analysis that concludes in a detailed trend forecast into the end of 2019 has first been made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $3 per month.